Chapter 23, Budget Planning. Everybody's favorite chapter. Budgeting, of all the chapters that we're going to cover in this book, I can almost guarantee you that all of you are going to have to do budgeting at some point in your careers. Because every company, big and small, does budgeting. Now, they don't all do it the same way. Small companies may do it very informal. If you're a small business and you're the owner and you have 5 employees, your budget might all be up here in your head. You have an idea of what your sales should be and your expenses should be. Maybe I knew one guy who actually had, in the old days, but before he had phones and everything in them, they had the day timers. You know, you carried around your little piece of paper and you wrote it down. And if you'd ask him what his targets were, he'd open them up. He had written down his target, his monthly expenses, his monthly revenues for his company. He knew right there what it was. That was his budget, just pieces of paper. Big organizations, though, are more structured, so they have a lot of organization pieces out there that have to be budgeted. And so we're going to talk about it from the standpoint of how the budgeting is done for a big company. The idea is that the same concepts happen in smaller companies, that they just may not be so formal. Okay? But you're all going to see budgeting. And the other thing I can tell you, not only are you all going to see budgeting in your careers, also it's not going to ever look the way that we're going to look at it here. Because it's management reporting and management accounting, budgeting is the most widely used management accounting report. And so as a result, every company changes it to meet their particular needs. When I did budgeting in companies, we oftentimes didn't budget the same way in the same company from year to year. We would change based upon personnel changes at the management level or changes in the economy. So budgeting always changes. With that in mind, though, the concepts do kind of carry through. So they talk a little bit on page 1058 about the benefits of budgeting. That would probably be something that's good to look at. The main reason we budget is because it helps us go through and do a plan, usually in the fall, October, November, in that period, for the following year. And then all during the following year, we can go through and compare our actual results with our budget. So it's a control tool to use and see if we were doing better or worse than we planned, and then to help us identify where we're better or worse, and so we can see what we need to do to make changes. So it's a control tool. So they talk a little bit about that. They talk about something on page 1062 called the master budget. And that pops up here. See, that's budgeting, the master budget. And the master budget really is a series of individual steps that all together lead to ultimately an income statement and a cash budget. So we always are going to start with the sales budget at the beginning, trying to do a forecast of what our sales are. And then once we know what our sales are, we need to go through and we need to figure out how many units we're going to produce. We're doing a manufacturing company here because it has the most steps. Sales companies, of course, don't manufacture things, they just buy them. And service companies don't have any inventory whatsoever. But nevertheless, if you understand these steps, then you'll understand for service and for merchandising. So we're going to do the manufacturing. So once we know what we're going to sell, we need to know how many we're going to make. When we know how many we're going to make or produce, then we know how much we need to order for materials, how to plan for how much labor we need, what our overhead's going to be. All that comes together. We take in the selling and administrative costs, and we put those all into a budgeted or forecasted income statement. And that's all what we call the operating budgets. So all those steps we go through lead down to this number. Now a lot of companies will stop here. But not all. Some companies, a fair number of companies, will also go to the next step, which is the cash budget. So this is where we project what kind of income we think we're going to do next year. Down here's where we say, okay, how much cash are we going to generate from running the business and making that level of income? And companies do this because it helps them forecast when they're going to be short of cash. So that way they can plan ahead and go to the bank and say, we're going to need to do a line of credit for these periods of time. Some companies will do a capital expenditure budget if they have a lot of equipment or long-term assets, like a transportation company, a trucking company, or a railroad company, or an airline. Or if they're a manufacturing company, they have a lot of equipment, a lot of factories. They'll spend money trying to plan when they're going to buy this equipment, and that's going to come into when the cash is used. And ultimately, all those go over to the balance sheet, the budgeted balance sheet. These are called the financial budgets because they look like the financial statements. But these actually have more of the steps of how we go through and look at the units that we're going to produce and then how much material we need and everything like that. Now, you're going to need to know this because in some way or fashion, I'm not for sure how it's going to go, I'm going to ask you to demonstrate that you know these and the order they occur in. Because it's important to know that you don't want to start working on the manufacturing overhead budget before you've got the sales budget done. Because all this, it's all connected. And so anything that changes up here is going to change everything that flows down after that. So you can't start one of these until these are done, because if you do, then you're going to have to redo the work when this information comes down to this level. So it's going to be important to know the sequence. In a small company, you may not have a flow chart that shows the sequence, but that doesn't mean that it shouldn't happen that way. So I want you all to be sure that you can understand that particular order. So I'd say that that illustration on page 1062 is pretty useful. Over on page 1064, they start off with the very first budget, which is the sales budget. Now this one's pretty simple. It's the most important one. It's what we always start with. It's the sales forecast. The forecast are the number of units that we plan to sell, and this comes from the sales department based upon looking at demand and the economy and competition and a lot of other factors. So the projection of how many units we're going to sell, normally it's done monthly. In this particular case, it's done quarterly, so don't have so many columns. And then you multiply it by your projected selling price, and that gives you your sales dollars. So this budget drives everything else. Okay? So the salespeople, sales department, marketing department, better get this right, because if they don't, they're going to have a lot of unhappy people. Because if they keep changing this, that means everybody else has to change all their work afterwards. And having been in the budget world and having seen how much fun that is, I can tell you, when somebody changes something upstream from you, you don't think highly of them. Well, you don't think of them positively, let's say that. So this is the sales budget. Now once we get the sales budget, then it's like, okay, we're a manufacturing company, we're going to sell 3,000 units in the first quarter. How many units do we need to make? And you might think, well, you just need to make 3,000, right? But that's not completely accurate, because when we get to the production budget, we have to figure out not just how many units we're going to produce to sell, but also how many units we're going to produce to have at the end of the period, so we don't run out of inventory, because you don't want to run out. Now there's a formula they have. It's called budgeted sales plus your desired ending finished goods inventory minus your beginning finished goods inventory equals your required production. So the formula is fine, but I like to think of it in a spreadsheet format, because that's how it really looks. So you start in your production budget by looking at your expected sales. So these were those units of sales that we planned to sell in each period. 3,000 the first quarter, and then each of those in the next quarter. Now here's where it gets a little tricky. Because we have to go through, we not only want to have 3,000 to sell, but we also want to have some at the end of the period. Because we don't want to run out. You don't want to start at the end of the first quarter, which would be March 31st. You don't want to sell down to zero, because then when you come in on April 1st, you don't have anything to sell. So somebody in the production area, the sales area, is going to sit down and say, you know, we don't want to run low. What's our minimum amount we need? And they're going to give you a target. In this particular case, the target is 20% of the following quarter's sales. So in order to come up with how many numbers we need here for the ending finished goods, we look ahead and we say, okay, how many are we going to sell in the second quarter? Well, we're going to sell 3,500. Well, we want to keep at least 20% of that in the warehouse at all times. So we're going to take 20% of that, and that's going to give us the 700. That's how we find what our target is. Okay? And then so we say, okay, well, we need 3,000 to sell in the first quarter. We want at least 700 in the warehouse at the end of that period, so we need 3,700. That's how many units are going to be required. Is that how many we need to produce? And the answer is, well, not necessarily, because if we have planned ending inventory, that means that ending inventory is going to carry over and be the next period's beginning inventory. So what we need to do is to subtract out the beginning inventory number. Okay? So let's come back to that. I'm going to show you how we're going to do this right here. So let's go to the second quarter. So again, second quarter, we're going to sell 3,500 units. That's our plan. We want to have at least 20% in the following quarter. We plan to sell 4,000. That's a few more, so we need to have more in the inventory than we did the previous period. So we take the 20%. 20% of the 4 is 800. 800 plus 35 is 4,300 units. Okay. Now, how many did we have at the beginning of the period? Well, on the first day of the second quarter, which was April 1st, we came in. Hopefully, we had the same ones that morning we did the night before, which was March 31st, which was the ending finished goods for the first quarter. So we carry that number down. What we had at the end of the first quarter becomes our beginning number. Okay? And then we just subtract that, because we don't. If we have 4,300 we need, but we already have 700 in the warehouse, we only need to make 3,600. And then we just go through and we keep repeating. Let's go to the third quarter. Well, third quarter, we want to have 20% of the following quarter sales, so we need 4,500 units, so let's take 20% of that. So that must mean at the end of this quarter, we need to have at least 900 units, so we have at least 20% of what we plan to sell in the next quarter. So we need 4,000 units to sell, 900 to put in the warehouse, that's 4,900, but we brought 800 from the last quarter, so we don't need to make those, so we only need to make 4,100. Okay, is that making sense? Kind of repeating. This one gets a little tricky because they gave you a number, but basically what happens is they have to give you some number, either the amount of the sales, which this is what it would work out to be for the first quarter, because it's the same 20%. We look ahead to the first quarter of next year, we say we need 20%, 20% is 1,000, so that becomes our 1,000. We add it to our target for our sales. We need 5,500, but because we carried 900 over from the last period, we don't need to make those 900, we only need to make 4,600. So most people, when they do this, they get that right. Where they always mess up is right here. This is where they always get confused. This is where all the mistakes occur. Okay? And that's because they're going, well, we started here, but how do we go back? Well, think about it this way. For a second, go back in time. Let's go back to the fourth quarter of the preceding year. Okay? So think about what we're saying. In the fourth quarter, we needed an ending finished goods inventory number. If they didn't give that to us, we could find that. What is our ending number going to be for the fourth quarter? Use that same rule. It's going to be 20% of what? The following quarter's sales, right? Well, the first quarter is the following quarter for our fourth quarter. So 20% of those sales would be 600 units. So if we were stepping back in time and going back to the fourth quarter, we would have just found that we needed 600 units in our ending inventory. Well, now go ahead to the first quarter. We're going to start that period. What are we going to start with? The same number that we had carried over from the fourth quarter. Because this is what we said we wanted to end the fourth quarter, December 31st with. On January 1st, which is the first day of the first quarter, unless our employees stole them all over the holiday party, we should have the same number here that we had at the night before. So students always get this wrong because they don't know what to do. So don't let that throw you. You do the same thing you did here, just step back and even though there's not a column, just write the fourth quarter in there and then just do that calculation again. Okay? So that's the production budget. And it's tricky because you've got to worry about not only how many units you're going to make for your sales, but you also have to factor in this ending inventory number, the target. Okay? But that's important because now the units that we're going to produce, you notice the production units do not equal exactly the sales units because of the changes in the inventory. The production units, and those no dollars and cents on here, just production units. The production units, that's what we're going to use then to order our inventory, direct materials inventory, figure our direct labor, and figure our manufacturing overhead. So these numbers are going to become important for the next 3 budgets we do. Okay? So that's the production budget. The next one that they have in that master budget in the next sequence is the big one, the direct materials quantities. Now, the direct materials budget, I'm not sure which side to do this on. Is basically the same thing as a production budget with just more lines. Okay? So there's a formula that you can follow. They give you in the book. The formula is how do I find the number of units of direct material I need to purchase, because I'm trying to figure out how much I need to buy. Well, I'm going to start with my direct materials required for the production, how many I need to use in my production. Again, I need to worry about running out. I don't want to run out, so I have to have a target for the ending inventory. I don't have to buy the beginning inventory because it's there, carried over from the last period. So that's going to give me my direct materials that I need to purchase. But I like, again, show it in a spreadsheet format, okay? So in the spreadsheet format, you're going, oh my gosh, that's a lot more. But really, what we just did in production budget, it's this section right here, okay? This is the production budget. We're just adding a couple lines above and a couple lines below, so don't let it throw you. So again, let's walk through this. So in the first quarter, we just found from the production budget that we needed to have 3,100 units that we were going to produce. Now somebody in production says, you know, every time we make one of those units a product, it takes 2 pounds of material. Well, that means then we need 6,000 pounds. So all we're doing here is turning the number of units we're going to make into how many pounds or ounces or yards of material that we're going to order. So in this case, I think it was 2 pounds. So this tells us how many pounds we need to order. Okay? Then we go through and say, okay, well, we need 6,200 pounds, okay, in order to have enough to produce, so that's what we're going to use. But we don't want to run out, because if we run out, the factory's going to sit quiet. So we need to calculate, again, an ending targeted for the amount that we're going to use. Well, in this case, somebody has to tell us, they tell us it's 10% of the next quarter's production. This is something somebody's got to tell you. Cost accountants don't know this. The production or inventory management people have to tell you this. So we say, okay, well, let's look ahead. Next quarter, we're going to have to use, we're going to make 3,600 units in the second quarter. Takes 2 pounds of material for every one of those units, so we're going to need 7,200 units or pounds of material. We don't want to run out, so we want to have at least 10%. So we're going to look ahead and see we need 7,200 pounds next quarter, so we want 10% of that, so that's how we get our 720. Okay. So then we say, okay, well, we need 6,200 units or pounds of material for what we're going to use in the quarter, plus 7,200 to have in the warehouse at the end of the first quarter. So we have a requirement of 6,920 pounds of material. But again, we don't need to buy it all because we have some stuff carried forward. So we subtract our beginning inventory, and that tells us then we only need 6,300 pounds of material. Now in the production budget we stop there, but here we're going to use this as part of our income statement, so we need to convert it to dollars. So the next thing we say is, well, if it's 6,300 pounds, how much is it going to cost? Well, we budget $4 per pound, and so we multiply it. We're going to spend $25,200 for that particular quarter for materials. And then we just keep repeating. So now we go to the second quarter. And we say, okay, well, we're going to have 3,600 times 2. We need 7,200. What's our target for the next ending inventory? Well, we look ahead. Oh, we're going to have a bigger quarter. We're going to make more items, so we need more pounds. So we need 10%. We better order some more. That gives us our 820. We add that together. We need 8,020 pounds of material to make sure we don't run out for our inventory safety margin and for our production. But we don't have to buy all that because we had 720 pounds that came over from the end of the first quarter, so we can subtract that. Since we already had it, we don't need to buy it again. So we only have to buy 7,300 pounds at $4, so that's what we're going to spend. So we just keep doing the same thing. We just look ahead, we need 10% of that, add it, carry the number over. We don't have to buy what was in the last period, and then we come up with our new number. Again, over here, they've got to go through and tell us kind of what our production is. I think in the book they tell us our production is 10,200 pounds. And so again, we use our look ahead, that's going to be 10%. So that's how we get our target. We add those together, carry our 920, sorry. Yeah, carry 920 over, we calculate that. Now, how do we find this number here? Again, our beginning inventory for the first period, the mistake that everybody makes. Well, again, for 10, step back in time, go back to the fourth quarter. So now you're at the fourth quarter. You're at the end of the fourth quarter, end of the year, December 31st. You're saying, gee, I wonder how many I need in this ending inventory number. Oh, I think I need, how much? 10% of what I'm planning to use in my factory for production next quarter, which is 6,200 units. So I need 620 pounds of material at the end of the fourth quarter. Well, magically, the end of the fourth quarter, the next day turns into the first day of the new quarter, or the first quarter. And so that's where that number comes from. So don't let that throw you. It's not that big of a calculation, but it does tend to confuse people. So that's the direct materials budget. And again, I think the direct materials and the production budgets are probably the two hardest. Because people always get hung up on this whole 10%, 20%, whatever the number is that's given to you. So don't let that throw you. Okay? Questions on that? No?
Is it a coincidence that let me get my phrasing, the total pounds needed for production in each case is $100 less than the direct materials purchases?
I would not assume that's a pattern that you could
Okay.
use on the test with accuracy.
Okay.
I'm guessing it's probably a coincidence, yeah. Somebody was also, talking about, well, this is always just 10% of that. Can you just do that? And the answer is, not always.
Okay.
Okay, so it's best to understand the theory and do it that way.
That makes sense.
Yeah, I mean, it might work sometimes, but it might not.
Maybe.
So I wouldn't want to take the test using that methodology. I'd use this. Other questions? Okay, so that's the direct materials. Okay, the next one we have is the direct labor budget. Now, compared to the ones we just did, these are easy. Okay, Because in direct labor, all we're going to do is take the number of units that we're going to produce from the production budget, multiply it by the time it's going to take. Somebody's going to tell us how many units of hours of time it takes. We're going to multiply then that, find out how many hours it's going to take to make a product, and then we're going to multiply that by the cost per hour to find our total labor cost. So that's pretty straightforward. We use, again, this is our production number, so it came from our production budget. So if you change production budget, you've got to change all this. They said it's going to take 2 hours, so 3,100 units times 2 hours is 6,200 hours. And somebody gave us an estimate next year of $10. That's one of our standards. We're going to talk about that in Chapter 25, the standards for usage for time and for price or rate. And then multiply that out, that gives us 62,000. So that's pretty straightforward. There's no inventory here. You can't save labor, right? So that's pretty straightforward. What else? The manufacturing overhead budget looks a little scary, but it's not. Don't let it throw you. What they do here is they break it into two pieces. If you remember back when we were talking about mixed costs, and I said we had to split mixed cost into fixed and variable pieces for the cost, volume, profit calculation, but also for the budgeting, well, this is where we are. We do our budgeting by two categories, variable cost and fixed cost, okay? And so the reason that we split it up that way is that the variable cost, somebody has to go through and give you that information, and they actually have that broken out on page 1069. They tell you somebody's done a study to show how much it costs for each one of these different categories per unit. So in this case, they have $1 an hour for the materials and direct materials, $1.40 for the direct labor, $40 an hour for the utilities, and $20 an hour for the maintenance. Well, the hours are what we use to allocate the cost, okay? So what we would do is, if you were doing units, you might just take the number of units and multiply by the price per unit. But in this case, we actually are doing the direct labor hours. So we would go back to the direct labor budget right here, and we would pull the hours that we're using off the direct labor budget for each quarter, and then we're going to multiply that by this number to find this amount here. So in a month where we have high labor, 8,200 hours, 4 times $1, that's going to be $8,200 for the indirect materials. So every one of these calculations up here is going to be a function of this number for that line times the amount of labor that's being used, because labor hours is what we're allocating our overhead based on. That's our cost driver for overhead. So that's all that is. So if you did an Excel spreadsheet, you'd just multiply all of those by these cells and you'd end up plugging in the numbers. Okay. The fixed costs are just that. They're fixed. They don't change. It doesn't matter whether you have 6,200 hours making 3,100 units or whether you're making 4,100 units. You're still using the same fixed cost. So in this case, they might either give you 80,000 for the year, and then you need to know to divide it by 4 to get your quarterly, or 12 to get your monthly. Or they might give you 9,000 for the quarter, and you just need to know, well, that's going to be the same for every quarter because it's fixed. So these numbers don't change. Okay? And so we go through and we add all the variable together, we add all the fixed together, then we add the two together, and that gives us our total manufacturing overhead. Now they do another step in here, because you're going to need this later on, where they say, okay, let's find what our average cost is per unit for overhead. So what they do is they go through and they do a little calculation, or a predetermined overhead rate. They take the manufacturing overhead cost of $246,400, and they divide it by the direct labor hours, because that's our driver, which was the 30,800. And it works out to be $8 an hour. And we do that because later on we're going to use that to do our cost of goods sold. So just, that's why that's there. But,
I have a question. When can we know the manufacturing overhead? Which one is fixed and which one is variable?
they have to give that to you. Now, lots of times in the book they don't necessarily tell you that, but like for example, depreciation is almost always fixed.
Yeah.
Things that you know are changing, indirect labor and indirect materials, those tend to be variable. Okay. Utilities, they consider those variable because you use more or less electricity, goes up or down. Maintenance, as your machines are running more, you do more. If you run less, they do less. Okay. Things like depreciation, any sort of salaries, anything having to do with the rent of the building or property taxes on the building or maintenance on the building, that kind of stuff is always going to be fixed. They really should tell you though, because it's hard to tell. I mean, you could argue that some indirect labor is fixed because maybe your indirect labor are all inspection people and they're all paid salaries. In the real world, the answer is you got to ask. Okay. So I add those all up and boom, I've got my total manufacturing overhead. Same thing for my sales, okay? Only the difference, the big thing here in sales, well, first off, we've got our variable expenses and we've got our fixed expenses, okay? So those look just like what we just did. But here's the mistake everybody does on this one. Up to this point, for direct materials, or for direct labor, or for manufacturing overhead, if we wanted to know what we were using to calculate the numbers, we went to the production budget, because we were running the factory and producing things, right? Well, now we're in the selling and administrative area. Well, we don't use the production budget, we use what budget? The sales budget. So these numbers up here across the top are the sales numbers, not the production. But because you've just been using the production budget 3 times in a row, you just go to the production budget, because that's where you're used to going. So you got to remember, if it's a selling expense budget, you got to go back to the sales budget to find the units. And then if you remember that, then the rest of it's pretty straightforward. They tell you $3 a unit for commissions and $1 for freight out. So if you have a high sales month like 4,000, your freight out's going to be higher at $4,000. If you have a small month like 3,000 units, your freight out will be $3,000. So those are all a function of the price per unit, because variable costs stay the same per unit, times the number of units of sales. Your fixed costs, again, they stay the same. It doesn't matter whether you sell 3,000 or 4,500. The fixed costs stayed fixed within that relevant range. So they either gave you a total for the year and you had to divide by 4, or they gave you a number for 1 quarter and you had to know that quarter stayed the same for each one. Either way, you add up all the fixed cost, variable costs, all the fixed costs, you come up with your total selling and administrative cost. So those have a lot of numbers on them, but they're conceptually pretty easy to put together. Now, where it gets a little tricky is getting ready to do the income statement, because if we've been going through the budget, the master budget, now we're getting ready to do the income statement. But one of the things we need to have on there is our cost of goods sold. So the way we do that is we find the cost per unit. We kind of find a standard cost, if you will. So we go back and we say, well, what did our direct materials cost per unit that we sold? Well, if we go back to the sales, this is the direct materials budget. Remember, it said that they used 2 pounds for every product, and each pound was going to cost $4. So it's going to cost $8 of materials for every product that we make. The labor, we spend 2 hours of labor on every product, and it was $10 an hour for the labor, so it's $20. For the overhead, it's allocated by hours, because they told us that was our cost driver, and again, it's 2 hours, just like the labor. Remember, they told us that it was $8, that's what we calculated on the manufacturing overhead budget down at the bottom. So it's $8 per direct labor hour, so if it takes 2 direct labor hours, that's 16. We add that all up, that becomes the cost of making 1 unit. So that $44 is what we're going to use when we do our cost of goods sold. So that's why we have to go through and have this little calculation here. Okay. And so what is our cost of goods sold? Well, if we go back and we look at the total number of units, again, that were sold, not produced, because this is cost of goods sold, we added up all the sales items that we're projecting for the year, because we're going to now go from quarterly to an annual number. It's 15,000 units times the $44. That gives us a total estimated cost of goods sold, or budgeted cost of goods sold, of $660,000. And then so when we put this on the income statement, that's where we see our cost of goods sold number, $660,000. The sales budget, the total sales, that's what we got from the very first budget, the sales budget, $900,000. Notice we're doing this for the whole year, not for the quarter. So, usually you do it a quarter, your income statement as well, but they summarize it to make it easier, so just letting you know that's for the whole year. We subtract the difference for our gross profit. The selling and administrative expenses, that came right from our selling and administrative budget. Then we had interest expense, they gave that to us, they told us what our interest expense was going to be. And then same thing on income taxes, they told us what our income taxes were going to be. And then so we come down to finally our net income number, which is kind of clipped off there. So that's how you do the income statement.
Where'd you get the 15,000?
What's 15,000?
Cost of goods.
The 15,000, that came from the sales budget. As a matter of fact, I want to go back because I want to show you something. I've noticed people are getting confused a little bit. The sales budget, they had total sales each quarter, if you add those 4 up, equals 15,000. So that came from the sales budget. Okay? I want to go back and touch on something because I'm finding people are getting really confused about this when they're doing the big water waste problem, because that thing goes on forever. Let's see if I can find it here. Oh, that's why they're confused, because it's not shown in here. Alright, let me just show you a little bit. One of the problems that's happening is when you're doing the waterways, if you go over to the side, it has you do it for the whole year, the calculation. Well, what it's going to do, it's going to say total pounds needed for production, so these are your pounds per quarter, right? So you're going to add all 4 quarters up to get you a number right over here. But then it's going to say add desired ending direct material. You can't add all those up, because if you add all those up, this is for a period of time, the whole year. This is at one point in time. And so the ending number for the year, the end of the year is the 4th quarter. So this number over here would be 10,020 is what you would use. You wouldn't add all of those up. You'd just take the last number for the last quarter. Same thing on the beginning. The beginning of the year, the first quarter is the beginning of the year. So you go over here, and so for the whole year you'd use 620 for your beginning. So if you're trying to add all those up and put that number in, you're not going to get the right answer. I've noticed a lot of people are doing that on the waterways. So the book, I didn't know why they were doing it, but now that I look at this, I see they don't show that, so that would be helpful if they did that. I might go back and put that in for next semester, I'll see. So that's the master budget. So again, knowing the order, knowing the sequence of how it all works is important, and then also knowing how to calculate the budgets, because you'll have at least one budget on there, maybe 2. Gotta wait and see. But if I were studying, I'd spend my time on the production and on the direct materials, because those are the hardest. So why would I want to ask you an easy one, right? What would be the challenge to ask you an easy one? Huh?
Do you have to do income statement?
No, because I'd have to give you everything else to do the income statement. So that would I'd have to give you like 5 pages just to be able to do it. So I'll just have you do one of the other pages, one of the others. Okay. The last one you have there is a cash budget, and the cash budget is kind of scary. It's really just 3 categories: cash receipts, cash disbursements, and financing. Okay, but if you look at it, and this is over on page 10. Where is it? 1074. You go, oh my gosh! Okay, don't panic. I don't think I'm going to have you do this one. Just to be sure, check the study tips. But I don't think I'll do that. But here's how it looks. Okay, first off, gosh, you can't really see it. I guess I can pull this down now because I'm not going to write on the board. This. You're going to start. Oh, I've been through this game before. There we go. You're going to start with what you think your beginning cash balance is going to be for the first quarter. So you go through and you say, we think we're going to start with $38,000. Then you go through and you say, okay, how much cash are we going to receive? And you list all the places you're going to get your cash. You're going to sell things to your customers, and your customers are going to pay you. You're going to sell some investments. You might sell some equipment. Anything you're going to sell in cash is going to come in. You're going to put in here as a cash receipt. Okay? You're going to add your beginning number to your cash receipts. In this case, those two are 170. So that's going to give you $208,000 worth of cash available. But of course, you don't get to keep it because you have to pay your bills. Now, some of your bills are going to go to pay your inventory purchases for your direct materials and whatnot. But most of your costs are going to go from like direct labor, your manufacturing overhead, selling, administration. All of those numbers there, labor, overhead, and selling and administrative, are going to come right from those selling and administrative budgets and the other ones that we just did. So you're just going to copy it over, okay? The capital budgeting is going to be where we say, oh yeah, we wanted to buy a truck, we wanted to buy a piece of equipment, a computer. So whatever quarter you plan to buy it, in this case they plan to buy a truck the second quarter, you put the cost of the cash you're going to use to buy the truck, because you're going to use that much cash for the truck, okay? And then they have income taxes. They tell you the taxes are paid out equally, so you have to pay your taxes every quarter. So that gives you your total cash disbursements. You subtract the cash you're going to spend from the cash you have available. That tells you how much cash you got. So that's your cash. That's your excess if it's more than what you have cash left over, or deficiency if you're under. And then you look at that and you say, I want to have a minimum number. Usually companies have some target that they don't want to fall below because they don't want to bounce checks or anything. And so the idea is if this falls below my target, I'm going to have to borrow money. Now here, my target I think is $15,000, so I got $25,500 projected as my excess of cash left over. I'm not going to have to borrow any money, so I just go and that's what I carry over. And then this number becomes my beginning number, and I go through the whole thing again. But now when I go through, I notice, oh, I'm short. I want to keep at least $15,000. I'm only projecting $12,000. So that means I got to go to the bank and I got to borrow the difference. This is where my line of credit comes in. I'm going to borrow that to get to my $15,000. And then the next month when I go through the same steps, If I have extra left over, which I do, I'm going to pay it back with interest. Okay? So this is the financing section down here. You may not, if you have enough cash, you may never use it. But the idea is when you fall short, you borrow up to the point to get to your minimum safety of cash balance, and then when you have extra amount, you pay that back. Okay? Now, the tricky part is collections for sales, collections for customers for sales, and purchase of direct materials. Because you think, well, don't we just go to the sales budget for that, and don't we just go to the direct material purchases budget for that? And the answer is no. Because let's take the sales, for example. The sales budget tells you when you're going to sell things, but it doesn't tell you when your customers are going to pay you. Now, if you only sell your customers cash sales, you don't have to worry about it. You just put that number in there and you're done. Life is easy. But most companies don't just have cash sales. They have to go through and they have to produce some cash sales, and they also have some credit sales where then they collect the money at a later time. Well, when we get ready to do the cash budget, we want to know when the cash is going to be collected. So we have to do another step to find this cash receipts collections from customers. And that's called the schedule of expected collections. So you can see here what we've done. We've gone back to the sales budget by each quarter, and we've looked at the month sales, and we've said, okay, well, that's what we sold, but when are we going to collect the money? And the answer is there must be some sort of a pattern or rule. Most companies will notice that there's a certain pattern. I have so many sales per month that are cash, then I have so much that are credit, and then when I collect my credit, there's usually a pattern. I collect more in the early months and maybe less in the later months. And so you have to take this number and spread it across, okay? So 180,000 of sales in the first quarter. We're going to collect 108,000 in the first quarter and 72,000 in the second quarter. Because they tell us of our sales, 60% get collected in the month we sell them for cash, and 40% are collected in the next month. And so we apply that 60% rule. 60% of 210 is 126, and then 40%, 60%, 40%, and then 60%. How about the 40% over here that fell off? Well, we don't care about that. That's in the first quarter, okay? That amount's going to be there when we get ready to look at the fourth quarter's cash receipts, okay? So that's going to be an account receivable that we have. But did you notice, look over here, what we had at the very beginning? We had an account receivable. What was that? That's carried over from the fourth quarter of last period's sales that now are getting collected in the first quarter. So you have to factor in not only your current period sales, but also any collections from the last period that may have some money coming in. Okay? Now, I'm guessing there's a good chance you're going to see this on the test.
Yes.
Yeah. But this is a confusing way to do this, okay? So I've got a better way that I learned from Mohinder, our tutor. Okay? She taught me this years ago. I had a way I used to teach. It was kind of like this, and students wouldn't do that well. When I'd ask them to do this on the test, they'd get confused. But I noticed the ones that got it right, they always did it Mohinder's way. So finally I said, show me how to do this. And so the last few years I've been trying to show how she teaches it. So I'm going to give you an example, but I want to give her full credit because this is entirely her way, and actually it works really, really well. So instead of using this example, I don't like this one because they only have like 60% credit and you collect all the, or 60% sales cash and you collect all the credit the following period. I'm going to go through and I'm going to set it up so we're going to use the example that we had for homework. Which one was it? It was E2317. So if you go over to page 1095 and you have E2317, we're going to use that example because that's more likely to happen where you have a sale and then you have credit sales, and your credit sales don't all come in the next month. They come in like for the next 2 months or 3 months. And that's more likely the way it works. So let me get this shut off and let's get the board going so we can see what's happening here. There we go. So we're going to go over and we're going to look at the Nieto Company. This is again exercise 2317 on page 1095. And they give us some budgeted sales. They tell us what our sales are for January, February, and March. So they give us 3 months. So our sales January total sales are $200,000, Our February sales, total sales, are $220. And our March sales are $250. Then they also go through and they tell us that we've done a study of what our patterns are for our customers, and we notice there's a certain payment, okay? We've noticed that of our sales, 30% are cash, so we get cash right up front, and 70% are credit. So a big part of our sales, we don't get the cash till later. All right? And of our credit sales, the 70%, we have a certain pattern as well. We get 10% in the same month we made the sale, same month. We get 50% of our credit sales, the cash collected, in the following month, or the month following, as they say. And then we get 4%, or what? We get 36% in the second month following sale. Now, if you add that all up, 10 plus 50 is 60 plus 36, that's 96%. We're collecting 96% of our credit sales. What happened to the other 4%?
Collection.
Those are the bad debts. You know, if we know the 4% of our cash credit sales we're never going to collect, you know how when we did back in 201 we had to put it all in at 100% and take out the 4%? Well, we're just doing cash projections here, so why put it in and take it out? We're just not going to put it in. So if your bad debts were going to be 2%, this number here at the end would be 38. You'd leave 2% off. If you collect everything, then that would be 40%. So just whatever your bad debt is, leave it off the last month. Okay? But what's important is these patterns repeat themselves. So what we can do is we can go through it. Now we've got to figure out the timing though when this cash, these sales occurred and how it came in based upon these patterns. So the first thing we probably want to do is go through and put our columns up here. Because we're trying to find when our sales got collected for January, February, and for March. Okay? So I'm going to go through, and because it gets really confusing, I'm actually going to draw lines, I'm going to make a grid. Alright? And so I'm trying to figure out what my cash collections are. Let's go over here. So the first thing I'm going to go through and do is I'm going to have two categories. I'm going to have my credit sales, and then I'm going to put down here, I'm going to put my cash sales. Because I know I'm going to collect both of those, but I'm going to put them in two different places. I'm going to show you why when we do that, okay? So let's go through in our credit sales. So the first month we have is January, right? January we had 200,000 in sales. So in January we had $200,000 total sales, right? Because that's what we said, $200,000. How much of those were credit sales?
70%.
70%. So we're going to take that times 70%. That's going to equal 140,000. Okay, so that's going to be January. Now, so now I figured, oh, it's just what we're doing here. Let's just do January down here. I mean, I don't care what the order, as long as you remember to do that. January cash sales, we had 200,000. And what percentage of our sales were cash sales? 30%, okay? Let's do the cash sales first. That's easy. So what month do you collect cash sales if you sold things in January? January. So what's 30% of 200?
60.
60,000. So you just put 60,000 in there. Boom. Okay. It's pretty easy. Now let's go up here to January. This one's a little trickier. So our pattern is we collect 10% when?
The month of
The same month, right? So in January, we sold them in January, we're going to collect 10%. So we're going to write 10% in the corner up here because we know we're going to get 10% in January. How much are we going to get in the following month? 50%. What month is that going to be?
February.
February. And then when are we going to get to 36?
March.
In March. So we just write the percentages in, the month that we're going to collect them, because now you can see where we're going with this. It makes it a lot easier to do the math. So now we say in January, we're going to collect 10% of our credit sales, so how much January sales are we going to get collected? 14,000. How about February? 50% of 140,000 is 70,000. And March, 36% is, I got that right here, 50,400. Okay. Again, these are all numbers, dollars. All right, wasn't that easy? Yeah, well, I like about this, I used to do it where I'd write the formulas on the side and carry it across with just one number. She basically puts the formula in the box. It's maybe not the neatest thing from a spreadsheet standpoint, but in terms of understanding it, it makes it a lot easier. And quite frankly, it's more important to understand it than it look nice. Because this is a supporting schedule, so this is only the bottom number here is going to actually end up over on the cash budget. So now we can go to February. So February our sales were 220,000. How many of them were credit? 70%, right? 70%, that works out to be 154,000. All right, so let's do the same thing. So let's do 10% in the same month. When did we sell them?
February.
February, so we're going to start at 10% in February. The month following is March, 50%. And oh wait, we ran out of boxes. Well, 36% is going to be out here. That would be April. We don't care about April right now, but it's not going to happen. It's just outside of the level we're worried about right now, okay? So what's 10% of 154,000? 15,400. 50% of that is, what's my magic sheet here say, 77,000. And just for grins, 36% of that is going to be 55,440, which is going to be collected in April, but we're not asked to find April's collections now, so that's why we're not worried about it. Okay? Oh, and don't forget, on the test, when I have given this in the past, people always forget this. They worry about doing this, they get this all done, and they add it all up, and they're done. They always forget to do what? The cash. So don't forget the cash down at the bottom. So February was 220,000. And again, it's 30%, so it's going to be 66,000, and it's in February. So now we come down to March. Our March sales were 250,000. 70% of those are credit. We multiply 70% times 250. That means our credit sales for the month are going to be 175,000. And again, we draw our grid so we don't get confused. Our 10% for March is going to be starting in March, so we put 10% here. Then we put the 50% in April. And in this particular case, we actually have some stuff that's going to dribble all the way out to May. Okay, we're not going to worry about that, but we should put it out here just so we kind of remember that, because I'm going to come back and talk about that. So 10% of 175,000 is 17,500. 50% would be some number here. I don't know what that is, and 36 would be some number here, but we don't care because we're not asked to do those numbers. And then finally, we come down here and we say the cash sales for March. It was 250,000. And again, 30% of those total sales are cash, so that works out to be 75,000. Okay. So now I can go through, in this particular case, they really only ask you to do March. Okay? They only ask you to total up March. But you could do all these, right? So my total cash collections are 219,900. I'm going to collect some stuff in April and May, but I'm not worried about that because I wasn't asked to do that. I'm going to collect some stuff in January and February, but in this case it didn't ask me to do that. But if I wanted to, I could just add those up, right? Okay, does that make it easier? Now there's one thing they didn't do here. I didn't like it, the homework. I couldn't find one that did this, but so I want to show it to you. Because there's a chance you'll probably see this, because in the past I've always liked to do this on the test because I think it's realistic. You notice how we have these little pieces here from February and March sales that fell outside of our period, okay? They're kind of hanging around, and in the next period they'll be carried over. Well, you know, probably makes sense that we probably have some cost over here, or some sales from over here from December and November, doesn't it? Okay? And if that was the case, we'd have some November sales that would have come in December and January, and we'd have some December sales that would come in January and February, right? Those would be called accounts receivable. Now, what would happen if I asked you to give me 3 months instead of just 1 month, which is what I like to do, and then you had to find what those accounts receivable were? What would you do? Same way, only what you do is what? You'd have 2 new columns, right? You'd move everything over. You'd start with November and December, and you put the numbers in from November. You wouldn't care about November's, but anything from November that went into January, you just write in here.
You'd give us the number?
I'd have to give you the sales numbers.
Okay.
Just like they gave you the sales here, I'd have to give you the sales for November and December. Okay. So if that happens, and I'm going to say that if I give you this problem, there's a good chance that will happen, practice it that way. Okay. I don't think the homework does it that way, but all I would do is I would give you November and December. So do it the same way, and then just like we ignored April and May over here, ignore November and December collections, but anything from those periods that came in January, February, add them up to the total, and you'll get the right answer. Okay? So that's a cash collections budget. So that's probably the most challenging part of the cash budget. Now, the disbursements budget, the payments for inventory and accounts payable, it works the same way, only instead of cash coming in, it's when the cash goes out. You buy some merchandise or some inventory on cash, and you buy some on accounts payable. I'm not going to ask you that. I figure if you know this, you'll be able to figure out the cash disbursement. So, but it works the same way. Okay. So what else? What else was in the chapter on budgeting? Cash budgeting.
If we go back to the income statement,
Okay.
actually the cash budget,
The cash budget on page
1074.
1074. Yes.
When they actually put their manufacturer overhead and selling, they took out the
Oh.
depreciation.
Yeah, I forgot about that because I wasn't going to ask you that. Yeah, that's true. Yeah, over on the selling administration and on the manufacturing overhead, you had depreciation added in.
Right.
Does that use cash?
No. So you
No.
have to take
So
it
you
out.
take it out. You're right. I completely forgot to mention that. So yeah. So again, everything on the cash budget is just cash going out the door. So that's why we don't put the bad debts in that we're not going to collect. And so we wouldn't put the depreciation in because we're not going to be using that. That's a good point. Thank you for mentioning that. Any other comments or questions? All right, so that's chapter 23. That's the big chapter. And when you get ready to work on the waterways, allow lots of extra time.